Welcome back to Alpha Recap. I'm glad you could join us. The market day has wrapped, and we're digging into what moved and what didn't on February 11th. As always, if you have questions, you can reach us at stockalpha.ai. Today, I'm talking markets with Kate, our fixed income specialist. Kate, thanks for joining.
Thanks for having me. Excited to walk through the tape from today and pull out what matters for investors.
All right, big picture to start. Markets closed in a pretty narrow range. The S&P 500 finished essentially flat, down only a hair, about 0.02%. The Nasdaq 100 actually led, finishing up about 0.3%, while the Russell 2000 slid about 0.5%. That split, tech up, small caps down, felt like the theme. Help us frame that, Kate.
Sure. The headline is concentration. A handful of large-cap tech names and chip-related stocks carried the day while smaller, more domestically oriented names lagged. That's a classic environment when investors are leaning into secular growth stories, think artificial intelligence and the chips that power it, and skittish on cyclical, consumer-sensitive plays.
You mentioned chips and AI. We saw semiconductor strength today, with demand optimism around Taiwan Semiconductor and renewed interest in chip makers tied to AI deployments. Walk me through why that's pushed the Nasdaq higher, even as the rest of the market barely moved.
Two factors. One, company-level commentary suggested pickup in orders for advanced nodes and AI-related capacity. When a big supplier like Taiwan Semiconductor signals firmer demand, perceived earnings leverage for much of the semiconductor supply chain goes up. Two, investors are still betting that AI capex will be a multi-year tailwind. That concentrates flows into names that will benefit most, and those names tend to be big enough to move an index like the Nasdaq 100.
So it's a flow story as much as a fundamental story.
Exactly. Positive demand commentary feeds discretionary capital, and funds chase the growth winners. That showed up in headline performance, a modest advance for the Nasdaq 100, while breadth behind it was pretty light.
Meanwhile, small caps underperformed. The Russell 2000 slid about 0.5%. The write-up we looked at pointed to middle-class strain from a large bank internal dataset and regulatory headwinds in areas like cannabis and healthcare. How much did those themes weigh on smaller names?
They mattered a lot. Smaller companies tend to be more exposed to domestic consumer spending and to single policy risks. A Bank of America internal dataset flagged weaker discretionary capacity among middle-income households. That increases the odds that consumer-sensitive small and mid-cap companies see pressure on sales. Add regulatory noise, which typically hits smaller policy-exposed businesses harder because they have less scale to absorb uncertainty, and you get underperformance.
Let's run through the sector story quickly. Semiconductors and broader technology were a clear winner. Communications and media were mixed. Retail had pockets of strength in direct-to-consumer and AI personalization, but headline-level consumer weakness tempered things. Financials traded cautiously and healthcare was split. Any highlights you'd call out?
Semiconductors stood out, not just because of demand commentary at Taiwan Semiconductor, but also because Broadcom kept investor attention as a proxy for enterprise AI and networking spend. In healthcare, you had a bifurcation. Policy-exposed subsectors felt pressure while businesses tied to AI diagnostics and data platforms attracted flows. Financials were muted as investors digested lending trends and internal banknotes on consumer stress.
You mentioned Broadcom. The article called it a barometer for AI capex sentiment. Is that still a fair way to think about the name?
Yes. Broadcom's exposure to enterprise networking and specialized chips makes the company a proxy for corporate investment in data center infrastructure. When traders talk about AI capex, they often look at names like Broadcom to gauge whether spending is accelerating. So investor interest there tends to be read as a signal for broader AI-related capital expenditures.
Shifting to company-specific news, a few names popped. Taiwan Semiconductor, Broadcom. Pfizer saw a disclosed sale that put pressure on it, and there was chatter about Astera Labs and a possible Amazon-related deal. How should listeners parse these headlines?
Company-specific items create episodic volatility. The Pfizer sale by a manager is an example of repositioning pressure, not necessarily a change in fundamentals, but it can move a stock when institutions adjust. Astera Labs and rumors about deal activity can spark interest if there's a plausible tie to data center wins. With Taiwan Semiconductor and Broadcom, the stories were more about demand signals that have industry-wide implications rather than just single stock moves.
There were also several filings in real estate and energy. Taylor Morrison and Transocean were mentioned for their 8Ks and industry disclosures. How material were those items for the broader market?
Those were mostly episodic and sector-specific. Homebuilder and REIT filings kept the financing and housing conversation alive, which matters for regional and housing-exposed plays, but they didn't shift the broad market. Similarly, oilfield services filings mattered for that niche, and commodity moves dictated whether the energy group had momentum. It's a reminder that much of today's action was dictated by stock-level news rather than a macro shock.
Let's talk Fed implications. There weren't major macro prints today, but the household stress signal matters. You wrote that weakening household finances could lower the probability of more rate hikes and potentially shorten the path back to a more accommodative stance if labor markets cool. Can you unpack that in plain terms?
Sure. The Fed looks at the economy holistically. If consumers, especially the middle class, start to pull back on spending because their finances are strained, that tends to slow growth. Slower growth generally eases inflationary pressure, which reduces the need for higher rates. So a deterioration in household finances makes it less likely the Fed will keep hiking interest rates and could bring forward the point when the Fed eases. Right now, the market is pricing a steady to slightly dovish path compared with last year, and that's part of why growth names that benefit from a stable rate environment are attractive.
From a fixed income perspective, Kate, did you see anything in bond markets today that reinforced that view?
Bond markets were fairly steady. There weren't big moves in yields that would suggest a dramatic change in Fed expectations today. But if consumer data starts to soften noticeably, you'd expect yields to come down as traders price in slower growth and lower future rates. Right now, it's more of a watch-and-wait stance.
A technical point the piece emphasized was breadth, or the lack of it. The S&P finished essentially flat while the Nasdaq 100 led higher, and the Russell 2000 lagged. Historically, when leadership narrows to mega-cap tech, the market can look strong at the headline level but be fragile under the surface. Explain that risk for listeners.
When a few large names do most of the heavy lifting, headline indices like the S&P 500 or Nasdaq can rise even though most stocks are flat or down. That means if sentiment changes and money rotates away from those big winners, the market can fall quickly because breadth was never healthy. It's like a stool with a few very long legs. It holds up for now, but it's less stable if one leg gets wobbly.
So what should traders be watching to monitor that fragility?
Watch ETF flows into large-cap tech-focused funds and outflows from small-cap ETFs, and monitor breadth indicators. The percentage of stocks above their moving averages, new highs versus new lows, that sort of thing. If flows into tech keep accelerating while the rest of the market checks out, the concentration risk rises. A shift in sentiment could then trigger a sharper rotation or correction.
Good practical advice. For listeners who aren't into technical indicators, what's an easy way to know if the market's breadth is healthy?
A simple check is how many stocks in an index are actually rising. If the headline index is up but most stocks are down, that's a warning. Another is to compare the performance of a tech-heavy index to a broad small-cap index. A widening gap like we saw today is the sort of divergence that deserves attention.
Looking ahead, the write-up flagged what to watch. Upcoming earnings, more consumer and credit data, regulatory headlines around cannabis and healthcare, and Fed speak. Which of those do you think could be the most market-moving in the near term?
Earnings and the consumer data will probably be the most immediate market movers. Earnings can change stock-level narratives quickly, and consumer data, given the Bank of America signal, can reframe growth expectations and Fed pricing. Regulatory headlines are more idiosyncratic. They can move individual names and sectors, but they don't often move the whole market unless they affect a large swath of companies.
Any tactical positioning ideas for investors right now, given the environment of narrow leadership?
It depends on your time horizon. If you're tactical and worried about a rotation, consider trimming concentrated positions and adding some exposure to areas that would benefit if consumer spending re-accelerates. Think select value or cyclical names. If you're longer term and confident in secular growth themes like AI, stay diversified within that exposure and manage risk with position sizing. Above all, monitor breadth and flows. They'll tell you whether the concentration is widening or starting to correct.
Before we wrap, let's boil this down to a few clear takeaways. Kate, give me 3 quick headlines an investor should remember from today.
1. The market closed in a narrow range with the S&P 500 essentially flat, the Nasdaq 100 up about 0.3%, and the Russell 2000 down about 0.5%. 2. Semiconductors and AI-related names led, driven by demand commentary from Taiwan Semiconductor and continued investor interest in names tied to enterprise AI like Broadcom. 3. There's a meaningful concentration risk. Narrow leadership and weak breadth mean investors should watch ETF flows, breadth indicators, and consumer data for signs of a broader rotation or a more abrupt pullback.
Perfect. And quick practical note. If you're tracking this from home, check the flows into major tech ETFs and the performance gap between large cap growth and small cap indices. That will give you a real-time sense of whether today's pattern is persisting or reversing.
Exactly. And don't forget that a lot of swings over the next sessions will be driven by company-specific news and upcoming earnings, so stock selection matters more than usual right now.
All right, that's a wrap for today. If you have questions about anything we covered, head to stockalpha.ai where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Kate, thanks for your time. Talk soon.
Thanks. Glad to be here. Talk to you next time.